Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management, founder and CEO of Shepherd Wealth Management, I should say. And glad to be back in studios here as we just wrapped up a fantastic Q1. Very excited to be doing quarterly reviews, which is already happening right now as we stand. And of course, we just wrapped up March Madness. Now we got baseball season kicking off, which is my favorite sport, even though my hometown Redlegs here got off to a good start. We'll see what they do this year. Not counting on winning a World Series by any means, but being a little bit more competitive would be great. But yeah, I don't know what your thoughts of the first quarter of the year are, Ez. But now that college basketball is over, I assume that you're just focused on the NBA right now.
Yeah, that was my security blanket, my comfort, was March Madness began in March. Yeah. Here we are in April. Yeah, everybody who watches the show know, big time NBA fan. Love live baseball. Yep. I'd say that's, even though maybe basketball is my favorite sport, I maybe would prefer to go to a baseball game. Yeah. So I'm looking forward to doing that. Hopefully with you this season. Those Red Leg tickets are going to be pretty cheap.
Should be.
But you're right. Now that Q1 is over, we left that in the dust and kind of know a little bit what we're up against with the Powell. The NBA is what I'm surrounding myself with now.
Yeah. No, it's a good distraction for me is sports.
Yeah, same here.
Obviously, family, kids, have a lot of fun. My youngest is in Taekwondo. My oldest is just, doing the cheerleading thing and so forth. So,
that's awesome.
Yeah, looking forward to this weekend. We got a big holiday weekend coming up here. We got Easter, people celebrating that weekend, Passover, or just, enjoying time off in general. So, very excited about the weekend ahead of us here. Might play a little golf if weather permits. And, just overall, not having to work on Friday, at least not from a trading standpoint. I'm sure I'll be doing something, but markets being closed Friday. Big news coming out on Friday as well. So we got employment reports coming out, average hourly wages coming out. These are all very, very important metrics that the market's going to be paying attention to, even though they can't do anything about it until Monday, and that leaves me to probably have to work either, depending on the data, that Friday or certainly that weekend. So again, we wrapped up a great Q1. Market's done fantastic, led by the tech sector, which we're heavily positioned in. For all those that have been watching the show, we remain in that position. We're going to talk a lot about really fun topics today, I think. But before we get into all that stuff, those that may be catching the show for the very first time, again, my name is Joshua Casey Garland, founder and CEO of Shepherd Wealth Management. I'm a certified financial planning professional. And the reason why we do the show is because I know, my clients watch the news.
Yeah.
I got the news on all the time, and clients watch the news throughout the day on their phones, etc., while they're working and traveling around, what have you, catch on the radio, whatever. And the news does a good job of being news, which is placating to headline events, which is typically driving directly at what every human being is hardwired with, which is just this emotion of fear and greed, this fight or flight, if you will.
Yeah.
Right? But what we do know about human beings as it relates to money and their emotions, fear and greed, thanks to the study of behavioral finance, human beings actually feel losses twice as much as they feel good about making money. And that's why people tend to watch shows like CNBC and Fox News, CNN, et cetera, because it grabs a hold of that. Whether it's the fear or the greed part of it kind of grabs a hold of it, and then it starts to really have an impact on how we make decisions. And I'm not knocking the news. The news is doing its job. My point is, the whole point of the show is not to say here's what's going on and why, but also give you some historical perspective, because history does seem to repeat itself. Buffett famously said the one thing we know for sure about human beings is they do not learn from history. I am here to provide that historical context, and the reason why I think that's so important is now it gives you a game plan for how to prepare yourself over the next 3, 6, 9, 12 months as it relates to the portfolio's asset allocation. So that's the reason why we do this particular show. Asset allocation is just a fancy way of saying this is how much of your money, Ezra, is in stocks, bonds, cash, crypto, whatever.
Yeah.
The cool part about that is we're in full control over the allocation. We could sit here all day. I mean, we all know what the headline news is: 40-year high inflation. The Fed's going to break the market. We got this financial crisis, geopolitical risk. I can go on and on. Inflation is going to stay stubbornly high. Earnings are going to fall off a cliff. This is going to be worse than 2008. I mean, I can go on and on. There's more bears out there than actual real life bears. You know what I mean? Yeah, so you put that in perspective.
Yeah.
I don't know how many actual bears there are.
Oh, man, that'd be a great pub trivia. How many bears? Just every kind of bear.
Yeah. Well, I mean, you don't have to. I mean, it's funny to say that, and it's just kind of came to me there. But
yeah.
And those of you that don't get the behind the scenes of this show, I am in tune to this stuff so much. I have like 2 bullet points here of stuff I want to make sure we talk about.
I'm looking at Joshua's notes right now, and it's not even like an eighth of a page.
This is a way for 2 things. A lot of fun for me. I hope viewers get a lot of educational information. I've got a lot of really good feedback from not just clients, but people that aren't clients that like to tune into the show. It's a lot of fun for me. Also, it gives me a way to vent.
Yeah.
You know, the title of today's show, by the way, I loved it. Barely Legal, B-E-A-R-L-Y.
Yeah, I mean, back to this whole mask of bears.
This has nothing to do with Stormy Daniels, by the way, the Barely Legal title.
Well, as we've said many times today, she was an adult.
Yeah. So. And, so, I mean, there's just, if you look at the data, there's more bearish positioning, just so much money in cash, even more so than the great financial crisis of 2008. You haven't seen this much cash next to people's portfolio from a retail perspective. This is all coming from Bank of America, by the way. You know, you just haven't seen anything like that since 2004. So you got to go back quite a ways. And that's why I love doing the show, is because if you were to just look at headline news, you would have no freaking idea that the S&P 500 is actually greater than 7% positive so far this year. And you certainly wouldn't know that the NASDAQ, the tech sector, which is the biggest sector by a long shot of all 11 sectors in the S&P 500, being up more than 15% year to date. So we're going to talk a lot about this stuff here today. And investors are cautious heading into Good Friday, this Friday, because they're trying to determine, in my view, and this is the main topic of today's program, did the Fed break the economy or did they break the back of inflation? So that's what I want to start today's conversation with. And then we're going to transition that into how it affects you individuals that are watching the show or clients that are investing here at Shepherd Wealth Management. All right. So investors believe, if you were to just look at, the Bank of America survey that's just referenced there, investors believe that the economy's broke post the Silicon Valley Bank crisis. And the vast majority of clients or prospects that I talk to are, obviously they feel nervous. I think there's a lot of, still internal feelings in a negative way relative to 2008. And obviously that was the worst event in the stock market since 1929. So statistically, this is not supposed to happen that often, although a lot of people, again, are positioned that way as if this was going to be, a super hard landing and this is going to be worse than 2008. I'll give you my opinion on that here in just a second, but let's get into the numbers a little bit. Arguably, in my view, the make or break view of this question, did the Fed break the economy or did they break the back of inflation? I believe, my argument is, we'll know here this earnings season, beginning on April 14th when JP Morgan makes their announcement for Q1 2023 earnings, and then every other institution across the S&P 500 over the next 4 or 5 weeks after that will be making their earnings announcement. I think that if earnings hold up, I believe that they will, then we can easily say, okay, the answer to the question is the Fed broke the back of inflation, which is a great thing for equities, of course. If earnings per share just completely falls off a cliff, like a lot of pundits may be calling for, then obviously we have to change our perspective a little bit on the weightings that we have for clients and their asset allocation.
Yeah.
However, I would say that over the past 6 months, earnings per share expectations have fallen, which is not a bad thing coming out of 2022. But 7 of the 11 major sectors, being communication services, industrials, which I like a lot, materials, healthcare, staples, and to some extent technology and utilities, they're only falling. I mean, really the only thing that's holding the market back here recently is energy and financials. Now, energy is kind of taken a completely complete, turn here.
Yeah.
Price of barrel was like $65 or somewhere in that area just a couple of days ago. OPEC Plus, which is, funny acronym. Essentially, they control the supply and demand of oil. Almost sounds like a streaming service.
Yeah, it does. That's the ad-free version of OPEC.
Sure, it's expensive.
Yeah.
Even with ad-free.
Yeah.
But yeah, so.
And you're still getting sold to the whole time.
Well, we went from 60s to over $80 a barrel for the price of oil. So you're seeing a little pop in energy stocks here over the last 2 days. But financialists, for obvious reasons, have taken the shorts pretty hard post Silicon Valley Bank. And I don't think that the majority of the market is positioned so heavily in cash because they think it's going to be a 2008. I think the majority of the market's heavily in cash because they're concerned that the Fed won't heed to actual data going on in the marketplace and actually force us into some sort of recession. Again, I have some thoughts on that here in just a little bit. However, as I mentioned, it's a great start to 2023 from a stock perspective. We here at Shepherd Wealth Management, for our clients that are looking for growth, their goal is to try to long-term do a little bit better than the overall S&P 500, better than the market. We thought October 12th, 2022 was the low for the year. Inflation started to roll over, therefore we got very heavily positioned into the tech sector, even more so than we already were allocated, and certainly benefited from that. Now, stocks have been resilient in the face of all these fundamental quote-unquote bear catalysts, such as the Federal Reserve hikes over 500 basis points. That's more than 5% in 12 months. Oil surges over $100 a barrel with the geopolitical risk in Ukraine caused by the Russian invasion. Inflation surges more than 9% in 2022. Regional bank crisis erupts in 24 hours, and yet stocks have managed to gain, as I mentioned at the top of the program here, 7% year-to-date in the S&P 500. The FANG stocks, so the big ones.
Yeah. I thought we were saying Mang now.
I guess Facebook I get that. Over 30% to the positive, right? For those big name stocks that got hammered in 2022. And then tech as a sector got hammered, pretty much the worst sector of the S&P 500 for sure. But that so far this year has done better than 15%, as I mentioned at the top of the show, in spite of all of these quote-unquote bear catalysts. So it may be, in my view, that the Q1 2023 earnings season, which happens here in April, as I mentioned, JP Morgan's kicking us off on the 14th of April, that's going to be the final capitulatory event. I mean, that's really kind of, in my view, the last leg that the bears have to stand on.
Yeah.
Is, well, earnings expectations are too high. You're seeing the data for inflation. I don't care what number you look at, CPI, the PPI, the core services, X housing. You can break it down however you want to. There's inflation's rolling over. The consumer expectations on inflation are significantly lower. And you don't have to look any farther than the bond market. A couple of weeks ago, in February, we were talking about interest rates, or the Fed taking their Fed funds rates north of 6%. You saw the 2-year climb over 5%. The 10-year was, doing all kinds of crazy stuff. And then we get the Silicon Valley Bank thing happen in early March. That changed everybody's expectations on inflation overnight, because you don't need to be a PhD in economics to understand that when there's that sort of uncertainty in the banking system, after having raised rates more than they've ever raised them in the history of mankind, in really 6 months.
Historical.
Definitely historical. The Fed even admitted the fact that in and of itself, that event with Silicon Valley Bank is going to cause credit lending to tighten. And that's the same thing as the Fed actually increasing interest rates. The difficult part about that is when credit tightens, just due to what happened with Silicon Valley Bank, you can't really accurately say, okay, that's equivalent to a 50 basis point hike as what the Fed would have done, or a 75 basis point hike. You don't really know until the data starts to come out. And on top of all of that, you've got these long lagging effects from increasing rates so much. You're seeing not only numbers on inflation roll over before Silicon Valley Bank, they're certainly going to do it after, and we'll talk more about that here in a minute. But on top of that, you got the bank actually tightening their credit lending. So this is in fact all deflationary. And I think the majority of investors, definitely my clients and definitely myself, felt like coming into this year the major risk was inflation.
Yeah.
Is inflation going to stay sticky? Is it going to come back in an upward manner, meaning inflation is now going up? Or, in fact, are we able to actually have a wrangle on inflation here with what the Fed's already done, plus what the banks are now getting ready to do? But I really think that the capitulatory event that would have to change my view, my bullish view, I'm one of the few bulls out here in the marketplace for sure. I've won so far, by the way. We'll get into some data here that really points to history saying that I'm probably still right. However, I've been right and wrong at the same time in the same day. We'll talk about that in prior podcasts as well. So everybody stay tuned. Now, I do want to spend a minute here on what the Fed calls supercore inflation. So what is supercore inflation metric? It's core services x housing. That's what they've hung their hat on as a reason to raise rates, even though Silicon Valley Bank failed, right? Bank failure, a lot of uncertainty in the market. Fed decided to raise rates anyway. Sounds kind of dumb to me, especially since it takes 12 to 18 months for that interest rate hike to actually impact the markets.
Yeah.
Pretty stupid, in my opinion. But that's what they did. Now, if the Fed's hanging their hat on the fact that this core services X housing metric is where they see sticky inflation, that's why they're so honed in on it. They wanted to see that come down to around their historical averages. Now, the historical average, if you look at the 65-year historical average for core services X housing inflation, is right about 4%. The 45-year average is 3.1. We just got the news on March 31st. Core services X housing came in at 3.3%.
Wow.
So we're there. You get to declare victory on that one too. I don't know why they don't, but we're going to find out here in May, all at the same time as we get more and more jobs reports. So we got some pretty cool stuff coming out here from an economic calendar standpoint. I talked about Friday. This week markets are closed. Everybody's going to get the same news at 8:30 in the morning about U.S. employment, unemployment, average hourly wages. All of these things are going to be super, super important. Nobody's going to be able to do anything until Monday, though. Then we get some wholesale inventory information, but the big news is going to be next week on Wednesday, February 12th. We get the CPI number again. On Thursday, April the 13th, we get the PPI, the Producer Price Index. And on Friday, April the 14th, you're going to get some retail sales numbers. Things of that nature. So next week is very, very important. I think that's why the market's being a little cautious leading into this Friday, being, again, a market holiday, being Good Friday. The data's been great, but yet you still get the Fed heads, as I call them. Today you had Loretta Mester coming out and saying, yeah, I think we still need to increase rates. I wish they would give you some actual reasons for that.
Yeah.
As opposed to saying, let's see, finger in the wind?
Yeah.
Still blowing like we need to increase interest rates here.
It's almost like they're trying to make you flinch, like that jock in the hallway in high school.
That is where I was going. It's like you read my mind. It's like they want to be, they want to talk this, tough talk, if you will, to try to keep a lid on what I believe would otherwise be a pretty awesome accelerated movement to the upside here in April. We're probably still running it anyway. I believe the data is going to come in exactly the way the Fed actually wants it to come in, which is lower inflation. You haven't completely crushed the job market just yet. And you still get the financial sector tightening credit, which is the same thing as increasing interest rates.
Yeah.
Which to me means if you want to stay higher for longer, great. Stay there for a little bit. Look around, see what happens. And continue to watch inflation fall, by the way. As opposed to saying, yeah, we got to increase rates. And the only reason why they're saying that is because they probably don't want to see the market rip up into the right before they get more data, which is going to come out freaking next week. So we'll see. We'll get the data, and we'll see how real data dependent these Fed heads actually are. Now, the other thing that came in really positively, not just for the Fed, but really should have been for the market, and I have a little bone to pick with the market on this one, at least today, is that we would argue that yesterday's jobs report, the JOLTS, that was also going in the Fed's favor. And that's another reason for fewer rate hikes.
Uh-huh.
The JOLTS report came in about 630,000 fewer job openings from the prior month. So the job openings came in from February, 930,000 versus the street estimate of 10.5. So pretty good drop off there. And prior to that, job openings were nearly 11 million. So you're seeing a pretty steep decline there. Now we're still above pre-pandemic levels. So again, yet the job market has not been completely crushed by all these interest rate hikes, which is a good thing. What we're also seeing is the job opening to worker ratio. Remember last year everybody was talking about there's 2 job openings for every person out there looking for a job. Well, that came down as well, which is, again, is a Fed goal. If they feel like they need to slow down services, well, if there's fewer people that have a job, well, that's 70% of the freaking economy, right? So services inflation is obviously coming down because of that. So these are all, the goal of monetary policy as it relates to bringing down inflation. The bone I have to pick with the market is you got everybody on CNBC and Fox News today, or pick your favorite news outlet that follows the stock market. They're like, oh man, there's this ratio of job openings to workers, and now we have fewer people. There's fewer job openings that are out there, so on and so forth. That would indicate that the economy is being crushed. Again, this is the question the market is trying to determine right now. Did the Fed break the economy, or did it just break inflation? Right now, everybody's positioned that the Fed broke the economy. I'm one of those few people out there that are saying the Fed broke inflation. Now, as soon as the Fed recognizes they broke inflation, the better for everybody, because it's going to provide some clarity as to what actually we need to do from a policy standpoint. And I have a little bit more to talk about that here in just a little bit. Additionally, we got ISM manufacturing survey in March. That happened on Monday. That came in exactly where the Fed wanted it to, meaning lower than analyst expectations. The number came in at 46.3. The street estimate was 47.5. The month prior to that, the number came in at 47.7. Again, this is disinflationary data points here. This is the lowest number that we've seen, by the way, since July of 2020. Prices paid slipped below 50 yet again. So all these metrics are showing signs of disinflation, yet we still have not had any Fed head, or specifically Jerome Powell, come out and acknowledge this stuff. I don't know why. If he's serving the American people, and if you're looking at things the way that the overall market does, and by the way, the market's the best economist on the planet because it's forward-looking. It's not backward-looking. The Fed's looking at backward-looking data, right? CPI, the headline number that we're going to get next week, that's the first inflation metric that comes out before PPI and then CPI, etc. That is giving an equal weight over the last 12 months on inflation. Obviously, inflation in the summertime of last year was exceptionally high. It was 9.1%.
Oh, yeah.
Right? Leading up to that, inflation kept growing. It peaked out in the summer, then started to fall a little bit. Not dramatically. It started to get a little bit more dramatic as we get closer and closer to the end of the year. That CPI metric, the way they calculate it, is giving an equal weight to all of them. So they're looking at backward-looking data as opposed to what the market's looking at is forward-looking data, which is exactly why you see the 2-year, which was, again, I think I mentioned this, over 5% just a couple weeks ago. You get the Silicon Valley Bank crisis happen, and essentially the 2 years hanging out around 3.7 at the moment.
Yeah.
The 10-year is at about 3.27. And the Fed's basically saying, yeah, we're going to take rates over 5%. So there's a pretty big gap there. Either the Fed's crazy or the market's crazy. And I gotta believe that the Fed's crazy, because if you continue throughout the rest of April, their next meeting's in May. Okay, so we get all the earnings per share information. We will get inflation information here in April. Fed doesn't talk until May. And April is seasonally it's usually the best month from a stock standpoint, and we're trying to benefit from that. But if the Fed decides to increase rates in May, which I'm not calling for, I think they're just going to hang out where they're at right now. Maybe they have to cut later on in the year. That's to be determined. There's too many variables between now and, let's say, the beginning of Q4, right, where there may or may not be a need to cut rates, depending on what actually happens with inflation. But my point being is if the Fed decides to increase rates in March, post a financial crisis, if you will, definitely not 2008, but a crisis of sorts, because 64% or so of all commercial real estate is in the regional bank's portfolio. So it's a huge, huge part of the financial system. And if they decide to increase rates in May, after we're probably going to get more disinflationary metrics on employment and inflation, I think they're going to look like complete fools. And they worry about their credibility. I think that's the reason why they increased rates last time, by the way, because it meant nothing to the market. It did nothing as it relates to the fight against inflation. They're going to look like morons. And they're probably going to have a bazooka blasted at them from, Senator Warren, right? Because he basically grilled Jerome Powell on Capitol Hill there a couple weeks back. Because they're going to cause unemployment, which is unnecessary, right? If you get inflation coming down, and you're still jacking up rates to kind of bring down the unemployment, the Fed's going to look like they lost complete credibility, which is a bigger problem for the overall market because that's their primary mandate. Yes, price stability, that's inflation. Primary mandate is financial stability.
Right.
We are the U.S., we are the world currency. We're the biggest economy on the planet. That's your most important job. So he's got to start to recognize a lot of this stuff. But what would be super helpful is he actually articulate that to the American public instead of just sitting on their hands and allowing this debate to go on within the individual investor's portfolio. And again, they're trying to answer the question, and they don't have all the information to come up with 100% the Fed broke the economy, or 100% they broke inflation. There's this real tug of war going on right now. But all the data suggests, as I've read them off here, that this is a lot of disinflationary events that are occurring right in front of our eyes, and the bond market's calling for it. Interest rates are falling, but yet we still have this excess level of fear.
Yeah.
And that's showing up right in the data from Bank of America as far as cash position for retail investors.
Well, I mean, one of their the Fed's big concerns recently was that, or maybe not the Fed's, but you saw that like don't do a run on the banks, your money's safe, and they're trying to reassure everyone that what happened at SVB wasn't going to just be this endemic thing that we got to pull our money out, right? Mm-hmm. And just back to your point, where a little transparency, just a little reasoning, even if it's not full on, like we're doing X, Y, and Z because of A, B, and C. I think it would assuage a lot of the fears, and people might be more willing to just put up with some of the opacity in other places.
Yeah.
I don't get it. I don't understand. It's like instead they're like, hey man, you get too many calories on that tray, and instead of just explaining why it's good to eat healthy, they just wipe all the tater tots off, which is the best part.
Right.
You're just like, come on.
I'm with you on that. But I mean, if you just look at the data from this week, I mean, yesterday's JOLTS information, the employment information, to me, this is all pointing to that inflation is broke and not the economy. However, earnings per share announcements, quarterly earnings announcements that we're about to be getting here, beginning April 14th and throughout the remainder of April and into May, is going to be a major driver of what the stock market is going to do for the remainder of 2023, most likely. So that's what our view is, and that's the recent data. Another important point here that I wanted to make relative to what history would have to say for all of those that are so bearish out there is the S&P 500 has posted 2 consecutive quarterly gains, which has never, ever happened in a bear market since 1950. And in our view, the first quarter gains in 2023 validate that the bull market started in October 12, 2022. And in fact, the S&P has been rising for 6 months, and investors are more bearish now than they were in October of 2022, as I mentioned before. So just in case you were living under a rock or
a pineapple under the sea.
Pineapple under the sea. So here are the major reasons for bearish sentiment. Inflation was supposed to accelerate in 2023. I just gave you a bunch of reasons and metrics that inflation's in fact cooling very sharply.
Yeah.
Earnings per share estimates were supposed to tank. Well, here's a big history lesson for all you guys who are just looking at information based on today. The market is forward looking. Okay. First of all, earnings per share has come in very nicely relative to what people thought was going to happen here thus far. Again, April is going to be big for that. Here's your history lesson. And I wrote about this in 2022. So go to shepherdwm.com. You can either check out the newsletter and or the podcast that goes over this specifically. The stock market actually bottoms 11 and 12 months before earnings per share bottom. We got that last year.
Yeah.
The recession was last year. If they end up calling a recession in 2023 because they couldn't call it that in 2022 because of how historically low, like 60-year plus low unemployment rate, even though we had 2 consecutive quarters of negative GDP and the market was down 20%. I mean, that was the textbook definition.
Yeah.
2022 was exactly the textbook definition of a recession other than the employment story, which is, again, why the Fed's so focused on
taking the tots off the train.
Craziness. But we got the market to bottom last year. Again, the market bottoms 11 and 12 months before earnings per share does. Hence, why I believe 2022 was a recession. October was the bottom of the market in 2022. We're actually in a bull market. If they call recession this year, let's say that happens. That would mean that it's either a rolling recession, which is kind of what you want to hear or what you're hearing from the pundits.
Yeah.
Or reality is it probably won't mean a whole hell of a lot because it's so backward dated, right? If we got inflation coming down and the unemployment rate staying relatively where it is today, around that 3.6 to 4 number, that's fantastic for the market. Now, the problem is, and this is what Elizabeth Warren was yelling at Chairman Jerome Powell about, it's like if you keep jacking up rates and people get laid off, and we keep getting disinflation information, he doesn't have a tool in his tool belt, because he used this freaking word tool belt all the time.
Right.
There's no tool belt to stop people from firing people.
Yeah, it's an axe handle. That's the only thing he has. There's nothing. It's not a tool belt with multiple things.
And by the way, I'm not a political guy. This isn't a political show. I cannot think of one other thing that me and Elizabeth Warren agreed on, but we agree on this one. So,
well, that's a political statement, so let's get focused.
We're focused. All right.
I'm just messing with you, man.
Number three reason for all the bears out there. Regional banking crisis was supposed to tank the economy. It did it.
Right.
Definitely did not. Now, I do think there is a risk here in the regional banking sector. I mentioned this before, over 60% of commercial real estate is in their portfolio. Plus, they have the same sort of bond portfolio, hopefully not as long in maturity as Silicon Valley Bank did. So they're sitting on a bunch of paper losses on their bond holdings as well because of all the massive interest rate increases that we've seen. So it did not cause the economy to tank, certainly not 2008. But we have to keep an eye on that because if the Fed wants to keep jacking around rates, then that could break something else. So I admit that is a real risk in the marketplace there. Again, this is all in the hands of the Fed, though.
Yeah.
Right? They can control all of this stuff. They just need to wake up and step in the shoes of Main Street instead of in their ivory tower.
It's almost like, despite the fact that they work for us, they're not.
Amazing,
they're not.
Amazing. It almost sounds like everybody in Washington.
Yeah.
Even though they're supposedly a completely separate entity.
Supposedly hired by us, they're not working for us. Well.
Again, this is giving the bears ammunition, right?
Yeah.
I hear you, but the data says something else. And that's exactly what the market's looking at right now. It's looking past all this stuff here and now and saying, well, what is this going to look like 6, 9, 12 months from now? Based on actual economic data. The CPI, the PPI, all the stuff that we just wrote off there, jobs report.
PCP.
It's all coming in the direction of disinflation. Number 4, the Fed was supposed to become more hawkish. Well, remember when they talked about rates being over 6% in 2023 just a few weeks ago? Rates are actually falling fast. The bond market's your proof of that. Long-term yields were supposed to soar, but have fallen consistently since February. I just mentioned the 10 years now continuing to fall. It's at 3.2%. In other words, various catalysts have come and gone, and the S&P 500 is still up 7% year to date. Well, I guess the next question would be logically, what about April? You may ask. Well, we expect April here at Shepherd Wealth Management to be the strongest month of 2023. That has a lot to do with the numbers that I just wrote off, but from a historical standpoint, April generally The third year of a president being in office is generally the best month of that president's 4-year term, and history would have to say that April is just seasonally a really strong month because you're getting Q1 data that typically has some tailwinds coming from Q4, which is generally the best whole quarter of the year. Now, that's one of the reasons why we're still bullish, but additional history lesson. Again, this show is not just about telling you what happened here in the news recently, but what does history have to say about similar events. So we got off to an awesome January. We got off to a great quarter. January was awesome. February sucked. March was awesome in the face of a Silicon Valley bank. 16th largest bank in the country, by the way, failing. If you look at all of history, coming out of a year where we had negative returns in the S&P 500.
Yeah.
Right? So that was last year, 2022. The first 5 trading days, if the first 5 trading days are greater than 1.4% positive performance in the S&P 500, well, that's only happened 7 times since 1950. That happened in 58, 63, 67, 75, 2003, 2012, and 2019. And based upon those 7 years, April has an implied gain, a median return of 4.2%. And that's been positive 6 of 7 times. The only time it was negative was in 2012. April was down negative 0.7%, which is not that much. So this would imply a plus 175-point addition to the S&P 500, which would put the index right around 4275 by the end of April.
Huh.
So that's kind of what we're expecting here. And this is, again, based on what history would have to say. And going back to the first 5 trading days when the S&P is greater than 1.4%, again, that's only happened about 7 times. Now, if history is going to repeat itself, which is important in our view because Buffett, I think Warren Buffett, everybody would agree, is probably the best investor in our generation, if not at all time. 65 plus years of doing it and doing 2 times better than the S&P 500 will put you in some rarefied air.
Oh, yeah.
When Buffett was asked what's the number one risk that individual investors have, he said themselves. The follow-up question was, well, why is that? And he said, one thing we know about human beings for sure is they do not learn from history, right? The market's made up of a bunch of human beings. We haven't changed in over 2,000 plus years, and history tends to repeat itself. Now, clearly past performance is not a guarantee of future results for all the compliance people that are watching the show. History tends to repeat itself, specifically in the market, because human beings are so emotional and so predictable over time. In the short term, it's kind of like a coin flip just because of all the emotional aspects of sentiment that individual investors have about whatever the headline news is. But the fact of the matter is, I think all these bears sitting in cash or cash-related types of investment instruments, they're probably just waiting for the ability to say, oh man, I told you so. I was right in 2022. 2023 is not going to be different. It might even be worse. But by the time they actually catch on to the actual bull market that's taking place right in front of them, again, assuming earnings come in fine, which I believe they will, and assuming the Fed actually takes the medicine and looks around and says, actually, the data is going the way that we were kind of hoping it would based on all the monetary policy decisions. I don't know why they don't say that. Like, that's a win. That's a Fed in your cap. Like, oh, yeah, we did all this crap. It was painful. But look, employment's still pretty good. Inflation's coming down.
Yeah.
Go forward, market, you're now free to take off into the right. I think that's what people are waiting to hear. You're not going to freaking hear that. And by the time you decide to go dip your toe into stocks again, you're going to be too late.
Too late.
You missed the boat. That's why market timing doesn't work. And that's why it's important to understand what history has to say. Otherwise, I guarantee you, there isn't a client or a prospect that I will talk to the remainder of this coming quarter between now and the end of this quarter that would have any idea what this rule of first 5 trading days is. They would have no idea that this happened 7 other times. They would probably also have no idea that we've never actually had a bear market when the S&P 500 has had 2 consecutive quarters of positive returns. Welcome to my show. This is why we do this.
Welcome to this reality.
This is what we do, okay? Additionally, the big risk coming into 2023 in our view is the Federal Reserve will over-tighten their monetary policy and cause a dramatic recession. However, the February PCE deflator, which is the super core services ex housing, again came in at 0.27%. This is the lowest since July of 2022. The annualized rate came in at 3.3. I think we talked about this at the beginning of the show, right, Ez?
Yeah, we did.
It's right in line with what they're looking for. And that's the thing that they're spending the most time talking about is core services ex housing.
Yeah.
You got it. Why don't you just say, hey, guys, we got it. We did it.
Yeah.
That's a good thing. However, go ahead.
No, I was just going to say it's Cadillac Margarita time. We did it. But no, we're not hearing that.
Yeah, and if you look at, again, the labor from the JOLTS report, still looks very strong labor market. However, it is, in fact, coming down, which is exactly what the Fed's monetary policy was geared to do. So that's what's going on. There's your history lesson. We are positioning ourselves here at Shepherd Wealth Management. When you have easing financial conditions would mean rates are coming down, you're seeing deflation without the labor market being completely destroyed. Easing financial conditions, what's correlated with that? Well, 88% of the tech sector is highly correlated with easing financial conditions. That's the reason why it's done so well, y'all.
Yeah.
What also does good? Industrials typically does fairly well. Small caps will do well. Small caps are getting crushed right now just because that's a big part of the small cap space is a bunch of smaller regional banks. So taking on the chin right now typically does well. Energy will probably likely do well just because of all the OPEC plus cuts that we saw. China's coming back to the real world, opening up their entire economy, which, by the way, I think people forgot because China was in an apartment more or less for 3 years. That's 20% of the global GDP. All bullish signs in our view. Now, I want to shift gears here a little bit because we talked about a lot of concerns. Or what is it that concerns a lot of individuals, right? Well, I like to do this little research project at the beginning of the year. I've done it for a long, long time now, and I'll continue to do it because this is the main reason why I love my job, love doing it, is really to help other people, and here's why. So this is coming from the American Psychiatric Association, all right? Americans coming into 2023 said, 64% of them said anyway, the thing that keeps them up at night, keeps them very anxious, concerned, and nervous is their personal financial situation. That's the number one thing, 64%. That's up from 58% last year. The second thing that kept them up at night, very anxious and nervous about, was the uncertainty of 2023. Now, I can tell you all the factual information, the historical information as it relates to why that uncertainty for 2023 probably shouldn't be as high on this list. I understand why it's second, though, because you got a lot of people that are making these decisions that started to say, well, we're data dependent. Well, now the data's saying you guys are winning the war here against inflation. You haven't completely destroyed the job market. All of these good things with your monetary policy tool. But yet they feel like they're hell-bent to take it to another level that the market's saying that's unnecessary.
Yeah.
Right? I get the concern there. I can't solve that problem today. I can just give you the factual, historical data. I can point to the market, kind of agreeing with all the things that I'm talking about here. The personal financial situation, though, 64% of Americans saying that's the number one stress in life. I actually looked at a different one, too, just so I didn't cherry pick, pretty reputable source here, the American Psychiatric Association, pretty good. But Capital One, and credit-wise, pretty good player, pretty big player in the financial services space. They also did the exact same survey, and they had a survey report showing 74% of Americans' number one stress and anxiety in life is their personal financial situation. Now, why is that something that's so important to me? Well, being a certified financial planning professional, that's what I am here to help with in solving those problems. Now, if you just look at the global pandemic, like nobody woke up January, 2020 saying, man, I'm really concerned about there being some sort of healthcare crisis that's going to shut the whole world down. Like nobody woke up and said that. When that happened, though, it was amazing for me to watch this very complex supply chain, global economy, all this stuff. It just pivoted on a dime.
Yeah. Now,
what allowed that to happen was the forces of the Federal Reserve and the United States government printing a bunch of money, more than history, causing inflation. But that's really what saved the confidence in our financial system, which, by the way, that's the number one mandate for the Fed. That's the whole reason why these guys were freaking created. That's why they have a job. Right? Price stability is one thing. Financial stability is the most important thing. My point being is if the Fed, the U.S. government, and other central bankers around the world can pivot on a dime that quickly, what that tells you is money is an endless resource, right? But yet the number one concern for Americans, the richest country on the planet, the largest economy on the planet, the global currency, their number one stress in life is their personal financial situation. Hell, there's so much money, they'll drop it from airplanes, right, if it gets bad enough. I mean, that's basically what we learned from the global pandemic and kind of what we learned from the banking crisis here with Silicon Valley Bank. I mean, they backed up all the depositors. They didn't have to do that. But that would have destroyed confidence here in our financial system, which is the backbone of what makes this whole big-ass machine work.
Yeah.
Right? So why is it that individual consumers, hardworking Americans, the vast majority of them, the thing that keeps them anxious and nervous and concerned at night is their personal financial situation. So how can we help with that? Well, one of the things that I want to point to that I think is just a mistake, and it's not anybody's fault because I'm not blaming Tony Robbins or Dave Ramsey. They're just too simplistic with their advice. They're always looking at, budget this and cut expenses. Well, clearly, right? I don't think anybody, needed a degree to say don't have high interest balances on your credit cards. Okay, that's a kind of an obvious one. So let's put that aside for a second. There's only so much you can do everybody has a personal income statement, right? You have cash flow at the top, revenue for the household or individual, and then all the expenses. And then what you have left is hopefully savings, vacations, homes, whatever.
Yeah.
There's only so much you can do on that expense side, right? You still got to eat, you still got to pay for your utilities, you still got to have a car, most places, and you need some place to live, right? Not a lot of stuff you can do there. You can cut out your Netflix subscription if you want to. For all those that have a gym membership they're not going to, it'll eventually get cut out at some point in time. But people spend so much of their time and energy on, well, what can I do with my budget to maybe clear out another $30 a month, right? I spend maybe 5% of my time on the expense side of my personal balance sheet. I spend the majority of my time focusing on the top line, the revenue line. Why is that? Again, not only can I not cut that many things out of my expense budget, and I've already done that to the best of my ability, but everybody has a talent of some way, shape, or form. There is something that everybody's good at. That's what their job is, whatever it is, customer service, making things, whatever. Now, you have let's say a job, paycheck, every 2 weeks, doing whatever it is that you're talented at. And that talent can probably be utilized in another way to generate another stream of income. Now, some people would say, well, I'll just go buy real estate. I love real estate. I am a landlord. It's my second favorite thing to invest in. I'm going to spend some time talking about that in more detail on the podcast one day. I'll talk a little bit about today of why I like it so much. But there's a lot of people that are making some money selling stuff online. Etsy, the Facebook Marketplace. You can create a website pretty cheaply these days, sell things online. Of course, there was always the eBay thing, so on and so forth. Or some people are just deciding to pick up, doing the Uber Drive thing, something. But cash flow is something that you have way more control over than the expense side of that personal income statement. Spend your time focusing on what am I good at and how can I scale this. And once you've kind of peaked out scaling it, well, maybe you just peaked out of that employer. Maybe you have the ability to actually create your own company doing the thing that you're already doing for an employer anyway. The scary side of that is you don't have that W-2 paycheck coming in every 2 weeks.
Yeah. You
don't have the health insurance. And I get all that. I went through all that and still dealing with some of those same fears here today, running the company that I have.
Yeah.
But I will tell you this, the ability to generate more revenue and help more people is far in excess today than it ever was when I was working at TD Ameritrade or Fidelity or any of the other places that I worked at for that matter. So I'm not saying everybody should be a business owner and all those sorts of things. My point is that if that is you and your primary concern is your personal financial situation, you need to consider how can I increase my top line. We'll do the best we can on the expense side of things, right? But most people aren't going to say, okay, my home's appreciated in value, so I'm going to go sell that. And I'm going to take my wife, my 2 kids, and my 2 dogs and go from 2,000 square feet to an apartment that's 800 square feet. Like, most people aren't going to take that kind of hit sacrificially, right?
Yeah.
We're going to stay in one bed and a couch, Probably not going to happen for most people.
Yeah, that's either a drastic necessity or just a mindset that is unique.
Exactly. You can't save your way, to being super successful. And for some people, that definition of success is completely different. Like I know plenty of people that I'm working with right here today with what some people would consider not even close enough to retire, but their lifestyle is completely different. They're totally cool. They're happy doing what they want to do. They're not financially stressed. They're not going to run out of money. But there are some people that would say there's no way in hell that you can retire on that amount of money. It's possible, depending on lifestyle. And for some people, they need to have a heck of a lot of money to sustain the lifestyle that they're accustomed to all the years that they're working. So the whole point is cash flow. Cash flow is the key to this entire equation about giving yourself financial peace. Because the ideal retirement scenario, I get this question a lot. What's the ideal retirement scenario? I would define the ideal retirement scenario as I wake up in retirement, no job, and I have enough income coming in to cover my lifestyle cost. It has nothing to do with the market, whether it's Social Security, if that's still around, rental property, maybe some people have a pension still from the baby boomer generation, that type of stuff. All those are inflows that have nothing to do with the stock or the bond market. That's where I want to start the ideal definition of retirement. My lifestyle is covered and it has nothing to do with the market. Therefore, I can be pretty aggressive. Even in retirement, I have clients that are in this situation, 60, 70 plus years old. There's no way that they could spend all that money. Because it's not that they have so much relative to a lot of other investors that are out there. It's because they have so much income coming in to cover all their lifestyle costs, which allows them to be fairly aggressive in the majority of their portfolio. And the last thing I'll talk about from a portfolio standpoint, if your personal financial situation is your number one concern, we talked about cash flow, not spending too much time on expenses, you need to consider concentrating the portfolio investments.
Yeah.
So you look at some of the wealthiest people on the planet, Mark Cuban, Warren Buffett, so on and so forth. Cuban would tell you that diversification is for idiots. Buffett specifically said diversification is, quote, important for those who don't know what they're doing.
Right, yeah.
Right? Now, if you've got a long time horizon, or if you're one of those older retirees I just described that has so much income, you can actually afford to do this for parts of your portfolio too. And we're doing that for some clients, not maybe for everything, but diversification is important if you are completely freaked out about the market. You don't want too much volatility. Great. Let's build an asset allocation model that will minimize the volatility and still get you a positive return that keeps up with your lifestyle. That is certainly something we can do. I think a lot of places can solve that problem. That's not a big deal. But for those that have the income and for those that are younger trying to build wealth to get out of this concern of personal finances, if you want to do better than the overall market, you got to take some risks. You don't need to be dumb about it and just like, oh, flip it. I'm going to go buy, Dogecoin or whatever. I'm not saying that that's a bad thing or some people didn't make money. I'm just trying to pick something that has been a super volatile asset class.
Seems like a meme. Yeah.
Or you could just concentrate the portfolio into some of the most highly diversified companies and highly profitable companies. What is that? Well, Apple's one of those. That would define that. You could look at Google and Amazon and some others, Nvidia, etc. You don't need, and Buffett would tell you that there's probably only maybe 10 companies of all 500 in the S&P 500 that are worth actually investing in. So why would you want to spend any of your time, energy, and resources investing in your 15th best idea?
Yeah.
Right? Concentrate that portfolio if you have the time and the risk tolerance from which to do so. That's a big piece of this as well. I think a lot of investors, when I see their 401ks, that's the bulk of people's assets, specifically when they're younger, they don't even know what they're investing in. They have no idea. They couldn't tell you what it's investing in, why, what the cost is to hold that. Does it actually match in their goals and time frames and risk tolerance? They couldn't tell you. That's a big reason why I have a job. That's why I love what I do. It's fun. It's easy for me. I get excited about helping people in that way and showing them, there's a smarter way to go about accomplishing your agenda here. And I just have to tell you that every year I see this number tick up. More and more people, bigger concern is their personal financial situation. The government's not going to solve it for you. Don't wait around for that. Society is not going to give you a handout, right? When grandma gets sick, It's not going to happen. It might sound cool that we're all going to live in unison and harmony, and that's great, being peaceful and whatnot, but it's not, it sounds good until there's a paycheck that's needed, and then that typically doesn't happen. So I think that this is a problem worth solving. I think this should be talked about more and more. Unfortunately, it's not, because the government's giving you all a very bad example of personal finances, giving the $32 trillion worth of budget deficit that we have here. So it looks like financial planners across the country are going to be gainfully employed for the foreseeable future. But in all seriousness, this is something that we're very passionate about solving for folks. It can be done, and you don't have to pay any pension in order to do so in most cases. So I really enjoyed this show, Ez. I know that we covered a lot of ground here with the markets, personal finance stuff. Anything we need to update or close with before I wrap it up?
Yeah, I just want to say how much I appreciate our viewership for hanging on while we had to do round 2 today. We had some unexpected technical issues, but it looks like we got them solved for the future. So we're happy to be on YouTube Live. We really think it's a great way to not only reach the clients that we have here at Shepherd Wealth Management, but the general public. So if anyone stumbles upon this show live or is waiting for it, also sees them on the archive, please leave your questions and comments or hop in the chat, and Joshua will answer them. And for our loyal viewers who saw us on our other platform, especially Brian from Shelbyville, we want to give you a shout out. I know we haven't been able to work taking your calls yet, but we're getting that in there. So
yeah,
hang tight.
Hit us up, 513-630-2664. Don't forget to check out shepherdwm.com. We post weekly blogs there. We're putting all of the newsletters that we post or send out to every client every single month. It's also now going on the website. So don't forget to check that out. And we look forward to doing this again in a couple of weeks. Hope you guys have a great holiday weekend. And we'll see you in a few weeks. Have a great rest of your weekend. Take care.